Fortunes are finally favoring the real estate sector, which has been facing slowdown since fiscal year 2012. As per the National Account Statistics 2022, nominal gross fixed capital formation grew at a CAGR of 6.5% since FY12 to reach 52.6 trillion rupees in FY21. It, however, underperformed nominal GDP, which grew at a CAGR of 9.5% over the same period. Household sector and private corporates contributed 74% to gross fixed capital formation in FY21, although down sharply by 500 basis points since FY12 when they contributed 79%. Within this, the contribution of real estate, including dwellings and other structures, to GFCF fell drastically by 1,200 BPS from 37.4% in FY12 to 25.4% in FY21. However, after the decadal downtrend, rising animal spirits towards investments are visible within private corporates in industrial sectors and household real estate.
Though various steps were undertaken towards reforming the sector, such as the Real Estate Regulation and Development Act of 2016, the impact on the demand front was not visible immediately. However, post the initial lockdown in the wake of the COVID-19 pandemic, the industry has seen a significant recovery. A culmination of various factors, including stagnant real estate prices in the preceding years, healthy growth in salary levels for white-collar jobs, all-time low interest rates, and government incentives had resulted in significant improvement in affordability levels. At the same time, the sustained period of work from home since the pandemic outbreak has resulted in strong preference towards home ownership, that too larger and better houses. These factors have resulted in demand recovery, especially for the larger and branded real estate developers.
However, the recovery trends are mixed across segments as the housing segment is seeing robust demand while commercial real estate is still lagging.
Talking about real estate, especially commercial real estate, and even within commercial real estate, leasable office space, the prospects are a mixed bag. We don't really know what the future holds as organizations are yet to decide whether they will move towards a complete work from office kind of a culture, or will make it a hybrid culture, or completely move towards a remote working culture. So it's quite a mixed bag here. But at the same time, tier 2, tier 3 cities seem to be offering a great value proposition for storage commercial real estate. Talking about residential real estate, we expect certain factors to support the growth in the demand for residential real estate. The prices of residential real estate seems to have bottomed out or at least cooled down, relative to what it was a couple of, given the unsold inventory situation, especially in most urban and metropolitan cities. At least from that standpoint, we feel that shouldn't be an issue now. And as the affordable housing plan of the government starts taking flight, and as there is an increased appetite for LIG, MIG sort of housing schemes, and the PMAY really supporting those aspiring for a residential piece of real estate, I feel all the stars are aligned to really stoke the demand.
That said, high input costs amid the ongoing Ukraine-Russia war is a near-term overhang. According to National Price Rise Impact Study 2022 by CREDAI, nearly 40% of real estate developers feel that they will not be able to deliver their projects if the government did not take steps to provide relief from a sharp hike in the prices of construction materials. The survey also revealed that there is a direct increase of approximately 20% in construction costs, which will have a direct bearing on the real estate prices.
In terms of the capacity utilization in manufacturing sector, as well as new project initiations, that is the capex plans, yes, there has been a sharp improvement in recent trends. Having said that, there is a pressure on input material cost, both in terms of the intensity of the cost increase as well as its trajectory in terms of whether it is going to be transient or permanent. And therefore, developers will cautiously monitor new project initiations, and no one would want to end the project at the wrong side of the cost cycle, and therefore trading cautiously on that account.
Against this backdrop, how should investors play the theme?
So industry would do well, and I think it will have healthy margins. But at the same time, as an end user, if I were to just buy and sit on it, maybe that's not the best idea. So how do you really play it? I think the best way to play it is participate in financial instruments that mimic the sector performance. You can invest into mutual funds that are sectorally focused on it, and few have come more recently. Private credit is a great way to play it, and there are certain options that are becoming available to do so.
Among individual stocks, JM Financial prefers DLF, Macrotech Developers, and Prestige Estates, while Sher Khan likes Mahindra Life Spaces, DLF, Oberoi Realty, Prestige Estates, Macrotech Developers, Puravankara, and Arihant Superstructures. Analysts say investors could also play the real estate theme by investing in allied sectors such as home improvement, home utilities, construction material, related commodities, and logistics.
A word of caution would be to not really take this as a blanket sort of an outlook, because what really matters is the exact sector that you're looking into and the exact companies that you would be looking into as an investor. So obviously the standard rules of asset evaluation applies.
On Wednesday, the Nifty Realty Index ended 0.5% up as against a percent gain in the benchmark indices. On a year-to-date basis, though, the index has shed 7% relative to benchmark's 1% dip. Meanwhile, stock-specific action amid Q4 earnings, weekly F&O expiry, and global cues will guide the markets today.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.